So on September 4th, 2025, if you just glanced at the headlines, you'd think everything was fantastic. I mean, the US stock market wasn't just doing well, it was hitting celebratory brand new heights. But if you look just a little bit closer, the reasons for the party were, well, they were a little strange. Let's break down what was really going on during this very peculiar market moment. Okay, so on that one single day, the S&P 500 climbed a solid 0.8%. Now that's a good day by pretty much any measure. But here's the thing, this wasn't just any good day. It was actually the 21st time in 2025 alone that the index had closed at an all-time record high. Incredible momentum, right? And this is where the whole story starts to get really interesting, a little bit complicated. What if the very engine that was driving this massive celebration was, in fact, a whole series of economic red flags? Yeah, that's the big paradox we're going to unpack right now. So first, let's just look at the simple, surface-level story, because on paper, it really did look like a fantastic day for investors. We're talking about a powerful, widespread rally that just screamed pure optimism. And this rally was broad, It wasn't just one little corner of the market. The S&P 500 set that new record, the Dow Jones jumped a solid 350 points, and the tech-heavy Nasdaq, it led the whole pack with a full 1% gain. Just green arrows everywhere you looked. But now we get to the core of this puzzle, the fuel for all that green. It wasn't some amazing corporate earnings report or news of booming economic growth. Nope, it was the exact opposite. The cause and effect here was just so direct. Two key reports on the labor market dropped, and both of them came in weaker than anyone expected. Private payrolls missed the target, and more people than forecasted filed for unemployment benefits. Now, normally that's bad news, right? But for the market on this particular day, it was exactly what it wanted to hear. And you can see the impact almost instantly. Just look at how traders started pricing the odds of the Federal Reserve cutting interest rates at their very next meeting. The day before, the odds were already super high, sitting around 92%. But right after that weak labor data came out, whoosh, it jumped to a near certainty of 97%. The market was basically screaming that a weaker economy would force the Fed's hand. And this all boils down to a really weird but powerful idea in the market. Bad news is good news. It's totally counterintuitive, I know. But basically, when investors see signs of economic trouble, they don't panic. Instead, they get excited because they believe the central bank, the Fed, is going to step in with cheaper money, in the form of interest rate cuts to prop everything up. But here's the twist. While the US market was popping champagne over the idea of stimulus, the global picture was looking much, much different. There were some really serious cracks starting to appear in that whole facade of global market stability. Let's just take China, for example. After this blistering 10% rally in August, its market just hit a brick wall. On the very same day the S&P 500 was hitting a new record, Chinese markets had their worst day in 5 months, dropping a steep 2.5%. I mean, what a dramatic reversal. So why the sudden drop? Well, it was for the complete opposite reason of what was happening in the US. Reports were coming out that Chinese regulators were actually worried their market was getting too hot. They were thinking about cooling measures to slow things down, and were even reportedly telling social media to kind of tone down all the bull market hype. Just two completely different worlds on the same day. Okay, so back in the US, another storm was brewing, and this one was in the courts. A really high-stakes legal battle over trade policy suddenly took center stage, and it was injecting a huge dose of uncertainty into everything. The Trump administration was appealing a court ruling that had declared a lot of its global tariffs illegal. And get this, President Trump himself framed the whole thing in stark market terms, flat out claiming that the stock market needs the tariffs. He was directly linking the outcome of a Supreme Court case to how the market performs. And the stakes here are just enormous. This single case could impact nearly 70% of all US imports that currently have tariffs on them. Think about that. If the original court ruling stands, that number could plummet all the way down to just 16%. This is a massive, multi-billion-dollar question mark hanging right over the global economy. So we've got a US rally happening on bad news, a Chinese market slamming on the brakes, and a major trade policy battle heading to the Supreme Court. And as if all that isn't enough, this is all happening as the market walks straight into a powerful, historical headwind. You see, stock market data going all the way back to 1926 shows that September is historically the absolute worst month for stocks. It's actually the only month with a consistently negative average return. There's a reason they call it the September effect. And this isn't just a US thing, it's pretty much global. Since 1950, the S&P has finished September in the green less than half the time. And you see similar patterns everywhere, from India's Nifty 50 to the Nasdaq. It is a remarkably consistent, kind of spooky pattern of seasonal weakness. Okay, so let's pull all of these different threads together. When you take a step back and look at the big picture, you see it's not just one or two little issues. It's like a volatile convergence of all these conflicting forces, and they're all hitting the market at the exact same time. So what we really witnessed on September 4th wasn't just some simple rally. No way. It was a collision, a messy, complicated clash between optimism and fear, policy and politics, and market momentum versus raw history. So when you boil it all down, you've got these four huge tug-of-war matches happening all at once. You've got the market's optimism fighting against clear economic weakness. You have U.S. investors praying for stimulus while Chinese regulators are trying to cool things down. You have this incredible momentum running headfirst into the market's historically worst month. And all of it is happening while a huge political court case hangs over global trade. Any one of these is a major story on its own. And all of that leaves us with the final critical question. The market is clearly climbing what they call a wall of worry. That's the old saying. But with so many conflicting pressures all converging at once, you just have to wonder, is it simply climbing that wall, or is it getting dangerously close to a breaking point?